On April 4, 2022, Mr. Deepak Parekh, chairman of the HDFC Group, announced a merger between HDFC Limited and HDFC Bank. By the way, this also marks the day when Valuationary was acquired by Race Financial Services. Seems like two great M&A deals happened on this day. Jokes aside, the HDFC merger has tons of implications for the Indian banking system and how the image of our banks would stand globally. Hello there. This can be a long video because we have covered every aspect of India's biggest corporate merger and how will this affect the Indian economy. Starting from the most important topic, how will it impact the retail investors? We all know that HDFC Limited and HDFC Bank both are listed entities, and with its merger, it will impact the retail investors of HDFC Limited. Let's see how they will get affected. With every merger and acquisition deal, there is a share swap ratio. So what is this ratio? Let's assume there are two companies, Company A and Company B. The value per share of Company A is 20 rupees, while the value per share of Company B is rupees 10. In our example, Company B is getting acquired by Company A. Therefore, the shareholders of the Company B shall be getting the shares of Company A. To make the deal fair, shareholders holding 2 shares of Company B shall be getting 1 share of Company A. That's how the overall final value will come out to be rupees 20 in both cases. However, in real world, it's not exactly equal, but very close to making things fair. Now, in the case of HDFC Twins, the acquirer was HDFC Bank, and the shareholders of HDFC Limited got the shares of HDFC Bank. I hope you don't get confused with the two names and stay with me till the end. The share swap ratio in this deal was 25:42. The HDFC shareholders holding 25 shares of HDFC Limited received 42 shares of HDFC Bank. So for every 1 share of HDFC Limited that I held as an investor, I'd receive 1.68 shares of HDFC Bank. Now let's come back to this date after the merged entity has started trading under the name of HDFC Bank. The bank has become the 4th largest lender in the world in terms of market value. Though the difference between HDFC Bank and the 3rd largest lender is huge, but we're up in the list. Now let's understand for how long the companies were planning in the merger and why did they merge in the first place. During an interview, Keki Mistry mentioned that the idea of merging had been under consideration for more than 7 years. However, the costs associated with the merger were not favorable due to the challenges of maintaining the priority sector lending norms, statutory liquidity ratio, cash reserve ratio, and achieving a satisfactory average liquidity coverage ratio. Out of many norms and ratio, to maintain the status of a bank after the merger, HDFC Bank must need to maintain a certain level of these 4 key ratios. Let's understand these 4 ratios one by one and how they play an important role in this merger. PSL, Priority Sector Lending Norms. The Reserve Bank of India requires banks to lend a specific percentage of their capital to particular industries, including renewable energy, micro-export credit, education, small and medium-sized enterprises, housing, and the agricultural sector. The requirement is to serve 40% of the capital for these sectors. HDFC Limited had an exposure of only 17% of these sectors, thus bringing down the overall average for the merged entity. But no worries, as RBI has granted a relaxation to this merged entity for 4 years to meet this criteria. Statutory Liquidity Ratio, SLR norms. This is the minimum percentage of deposits that the commercial bank maintains through gold, cash, and other securities with themselves and not with the RBI. The current minimum SLR in India is 18%. The pre-merged HDFC Bank maintained an SLR of 25%, therefore the impact on this ratio after the merger would be minimal and the combined entity is expected to meet this criteria easily. Cash Reserve Ratio, CRR norms. The cash reserve ratio is the percentage of total deposits a bank must have in cash so that they can operate risk-free. This amount is kept with the RBI for financial security. The bank cannot use this amount for lending and investment purposes and does not get any interest from the RBI. Currently, the CRR rate is 4.5%. Being an NBFC, HDFC Limited was exempted from this norm, but HDFC Bank maintained it enough to ensure that even after the merger, it doesn't go below 4.5%. Average liquidity coverage ratio, LCR norms. Liquidity coverage ratio is nothing but the proportion of high-quality liquid assets bank hold vis-a-vis the total net cash outflows over the next 30 calendar days. By high-quality liquid asset, what I mean here is that every asset that can be easily and instantly converted into cash at minimum or low cost of value. The average LCR ratios for the merged entity should be 110%. But merged entity is maintaining LCR ratio of 120%. So they're doing a good job here. So HDFC Bank ensured in the past 5 to 6 years they do well on these ratios so that they're able to merge the two entities and ask for exemption for a few years to bring up their PSL ratio, which they duly received. I hope by now you have understood why this merger took almost 7 years after it was thought through by the top management. Now let's evaluate why did the two giants merge and how profitable this merger would be. Reason number 1. Cross-selling of products. Currently, around 70% of HDFC Limited customers do not bank with HDFC Bank. And likewise, 80% of HDFC Bank customers do not avail loans from HDFC Limited. This highlights the immense potential for cross-selling various financial products and services to these customers. To give you a perspective in terms of numbers, HDFC Bank brags a customer base of 8.3 crores, while HDFC Limited serves 0.54 crore customers. Imagine, if they're able to cross-sell products easily, the books of the merged entity would skyrocket. So will their revenues and profits. Reason number 2, operational efficiency in cross-selling the products. According to Keki Mistry, cross-selling products used to take a lot of time, and this makes sense too. Let me tell you how. If I want a HDFC Bank customer to transact with HDFC customer, I would have to send across all his documents to a different company altogether and they would undergo their review procedure. Now with the merger, all of this can happen under one roof, thus bringing in the much needed operational efficiency. Let's see how this fares out in the future. Lastly, let's evaluate the additional profits this merger might bring to the HDFC twins. For that, we need to understand one very important ratio. This is the cost to income ratio. It's an important measure used to assess the efficiency of a company or organization. It compares the operating costs of a company to its income. A high cost to income ratio suggests that a company spends a significant portion of its income on various expenses, which may indicate inefficiency. Conversely, a lower ratio indicates better expense management and potentially greater financial stability. Initially, the cost-to-income ratio of the merged entity is expected to increase to 38 to 39% due to the bank's plan of opening over 1,500 branches. This will be in addition to the existing network of 8,500 branches the combined entity has. However, the ratio is projected to decrease to 30 to 33% over time, indicating improved cost control and better efficiency. The future prospects of HDFC Group may seem promising on paper, but there are a few concerns which we will address. Number 1. Execution of the plans at the ground level. All the advantages that we spoke about earlier needs to be executed with perfection to ensure that the benefits actually come in and there is value unlocking for the shareholders. Number 2. Change in the management of the combined entity. After the merger, Mr. Deepak Parekh decided to retire, marking his last working day after 46 years with the corporation. This departure was followed by a significant change in the senior management of HDFC, with approximately 70% of executives stepping down from their positions. Only 3 out of the top 20 executives will continue in senior roles within the bank. To add to this, CEO Keki Mistry and MD Renu Karnad have also stepped down from executive positions but remain as directors. HDFC Group merger is a sign of the strength of the Indian banking system, which has stood strong even as other global banks have collapsed. In 2023, more than 3 banks collapsed around the world, including Silicon Valley Bank. But India's banking system remains stable, thanks to its strong regulation and oversight. The merger is also a sign of the growing maturity of India's financial markets, as India's economy continues to grow, there is growing demand for financial services. The merger of HDFC Limited and HDFC Bank will help to meet this demand and make India's financial markets more competitive. If you enjoyed this video, please share it with your friends and your colleagues. And don't forget to subscribe to Upsurge for more such interesting finance videos.